raining hard in the markets this week, and so wanted to go over basically what to do if you receive a trade alert and the market has moved, and what you should be evaluating in a sense in order to decide whether or not to take the trade and or adjusting that trade. But before we get there, real quick, hey, if you've never been to Moab, you definitely go. This is a picture of Gemini Bridges. It's one of the many, outstanding, formations that you can find right outside of Moab. We're big bikers, so we biked up there with the whole family, and you can see that even for young middle schoolers, they can find elation and natural beauty, even though you're whipping them a little bit on the physical side. So it was a wonderful trip. If you haven't been there, definitely put that on your bucket list and make it happen. All right, without further ado, then let's get back to the charts and let's talk about what we're looking at, what we're seeing, and what I see in setting up a trade. And then we'll talk about how it affects you kind of in the future on how you may want to adjust the overall trade itself depending on when you enter. Okay, so what I've done is we're in Thinkorswim. We're on this special feature that's called On Demand. You can see it here. Basically what I've done is I backed the charts and the timing up to March 28th. And you can see the time, that's 8:27 Mountain Time. So we're going to take a look at what I'm seeing, the overall points and why we're making a decision. And we can actually look at the chart itself in real time, all right, looking backwards, and then show how this will work for you. So so the first thing to notice on this chart, here we have a 5-minute chart. This is the SPX, and what we have here is we kind of have this series of, if you will, right? We have basically a lower high right here, to a lower low. Again, we get another lower high. We get a lower low. We seem to be hitting some support. We're in kind of this a band right here. And then again, we get this lower high to a lower low. It seems like we're banging off support and we're coming up. So given that we're not in a great, should we say, uptrend, but we definitely have some support here at 27.85. And you see how with this really, monster drop, at this juncture, and that was due to news on the global scale. And that news on the global scale, we'll go ahead and take a look at it real quick, was two different things. Basically, number one, China came out and their industrial profits, you can see right here that we have this slowdown from 16% to 10%. And that's what's happened with the market. They're like, everyone's really afraid right now that the global slowdown, and is that global slowdown going to affect the U.S.? The other thing that happened is that Germany put out their bonds, and it was totally oversubscribed. And what makes that notable is that Germany right now on their bonds, it's a negative interest rate. So you're basically getting a negative yield, but it basically means that in the Eurozone as well, they're looking at risk off, and they're trying to find at least a safe haven for their dollars. So that's why we had this big drop. Let's go back to it here. This big drop, right here. So what my concern is that we're kind of maybe, pumping up here for what's known as a bull trap and coming down. That being said, conversely on the bull side, we have to look at is we have a nice uptrend. We do have solid support, and we're following the ADMA. Also, if I take a look at this from, a large perspective, I like to see if we have any headroom. And I'll do that by taking a look at the fibs, and I'll take a look here, and I'll go ahead and I'll pull the fibs up, and I'll draw from this high basically to this low. And the key thing with the fibs is that they love to retrace in this kind of 50 to 61% zone, and you can see that we can still go up to like kind of this 28-30 level. So if we entered a trade, we would get some positive price action moving away from a put credit spread, and at the same time, that happens time, and we get some time decay. So both those things would work in our fashion. So we're looking bullish, but at the same time, we want to be cautious because there's a lot of things happening. Let me just remove this. A lot of things happening on the global scale. In addition, on Thursday, even though we have prices going up right here, our GDP was also negative. Let's take a look at that real quick. So GDP came out, and you can see right here that for the past 3 quarters, that GDP has been falling, right? Even though it's kind of met the expected number of 2.2%, we've fallen, basically almost cut GDP in half. So that's adding some pressure, and the market is really kind of known for, having a knee-jerk reaction, pumping things up, and then ripping your head off. So even though we have 27.85, we went ahead and put the credit spread down here, at this 27.65 level in order to give us kind of this 41-point cushion. So if we take a look at how that happens and why that happens, like, okay, we're bullish. We definitely want to give us a large cushion. And so in real time, right, we can go ahead and click this on demand. You can see now the charts are actually moving. I'm going to move this up a little bit to about the 830 level here just to save you guys some time. And we'll hit go. You can see we're about 830. Now I'm going to move this down to a more granular 5-minute. And you can see here that we have what's known as a kind of a bull flag. We got a nice flag stick coming up with a pennant right here. And so we're looking for an overall entry. I'm looking for to break this high, right? We break the high of the previous bar. That says we're bullish, as well as that we're hanging on to this yellow line right here, which is the 8 EMA. So as long as we hang on those two things, it's going in our favor. And you can see that I sent the post out to you guys about 8:33. Of course, I get filled before you do, so you know that I have the same skin in the game and managing it the same way. And as the market moves, you can see that it's pulling that attention, and that it's coming up. And so if we're going to go ahead and make that trade, we come back to the trade, and you can see here, this is showing the SPX option chain, and it's showing the vertical spreads. So here we are looking right at basically what I'm trying to find is that, kind of that 25 cents. So if you add these up, between the bid and the ask, that's a 65. So that's kind of like 30, give or take a few, depending, this isn't exact science on the replay. But this gives us then, kind of that delta of what we need at the 27.65. I'm the wrong one there. Let me just pull that back in for you. Sorry about that. I'm sorry, 30 cents. So it's it's in that 15, 20 cents of where we're going. I think we said it was overall 20 cents. We were wanting to get into it with the extra large cushion because of the global factors that happen on the economy. And you can see here that this gives us about 40 points of right. It's trading about, you can see up here, it's traded 18. We'll just call it 15, so that gives you 40. So it gives you a decent cushion. So that's why we went ahead and sent that out. So go back to the charts, and we'll do that. I'm sorry, let's get rid of this first. And go back to the charts. And you can see we didn't break that bar's high. It happened like at 8:32. You got this at 8:33. So normally, if you were able to get the alert and execute the trade, you're in really good shape. But obviously, this is the workaday world. That's not always reality. You guys are busy, and things happen. So let's say, for an example, that you didn't see the alert, for 30 minutes because you're in a meeting. So we'll go ahead and we'll forward this up a little bit, and we'll kind of kick this up. So you can see it's 8:45, and now we're at 8:53, and we'll go in a little farther. Okay, so now we're down like 9 o'clock, a good half hour, and we've dropped basically about 12 points. And so in dropping the 12 points, if you went ahead to our original trade and executed it, we'll go back to the overall trade cycle here, and I'll go back and we'll highlight this point in time, the 20. Let's see, the 20. Here we go, 27.60, 20.65. Hold on a second. For some reason, this this is at 9:03. This didn't adjust. Hold on. Let's see what's going on with that. Let me pause this for you. Okay, sorry about that, folks. The on-demand function was having a little bit of a problem. But you can see here that, you know, when the price dropped, okay, we'll go back to the charts. And let's go ahead. Go back to the charts, right? So if you didn't get in right away, you know, you're in like 30, 40 minutes late, and the price comes down, you know, say to 2,800, and you're like, oh, what should I do? And I go to the trade piece, and you see here that here you are at the, you know, 60, 65. So that bid-ask spread, it's probably trading for, you know, 50 or 55 cents. Now you're like, wow, I can get a ton of premium for that, and that's definitely true. And if you really believe that 65 level and that 27.85 is going to hold, then that is definitely an option. You can take more premium, but you have to realize is that you've really changed your probabilities, right? Now from 2665 to 2800, you have a 35 point cushion, okay? Instead of before we had, you know, kind of a 40, 50 point cushion. So therefore your probability of that trade at that point in time being profitable is less. So what you may want to consider is saying, hey, what if I move this down a little bit? What if I move down here to say the 27, you know, 45, 27.50, give myself, you know, 15 points of extra room, and I can probably see that's 15.45, so it's 60 cents. You know, you got 25, 30 cents premium you can get there at a much higher probability. Either one is correct. I just want to make sure that you understand the trade-offs in either staying at the current strikes versus moving the strikes down, right? It's all probability, risk and reward. You have an inverse, right, relationship between, you know, risk and reward, right? We're a little bit closer, so we're gonna get more. We're gonna get paid for that, okay? But the probability of that trade being, you know, being successful is lower. So you may want to consider moving it back. All right, guys, that's good. I just want to make sure that you knew what to do, just in case you couldn't get filled. You know, definitely take advantage of moving the strikes if you want to, in order to keep the same probability. If you want to grab a little bit more premium, go for that as well. Just note that I will be managing the trade based upon the profit and loss graph of what we put out, and they should help you, you know, monitor, you know, what you actually traded, and you can make some decisions from there. All right, have a great weekend. Talk to you soon.